Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today on the show, we've got Noah Solomon of Outcome Metric Asset Management, and he focuses exclusively on Canadian dividend-paying stocks. And I know that's super interesting to you just on the surface, but the way he goes about it is very unique. It's all AI driven. So applying this new technology to a tried and true method of Canadian investing. And guess what? He has a track record of outperforming. How does he do it? Yeah, he still owns Royal Bank and TD Bank the way pretty much every Canadian dividend investor owns it. But he says the secret is how you weight those stocks. We're going to dive into the model and the outcome metric story. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. I started learning about investing in my 20s, but as a mom, I'm already thinking of ways to teach my kids about investing now. Here are 5 easy ways to help your children start investing. First, let's talk about an RESP. This is a Registered Education Savings Plan. It isn't just a savings account. You can actually invest the money in stocks, bonds, and ETFs. Plus, the government kicks in up to 20% through the Canada Education Savings Grant. That's additional money helping your children's investments grow faster. Now, the second is to open an informal trust account. In Canada, an in-trust for account is one of the simplest ways to start investing. It lets parents or guardians hold investments on behalf of their children until they're old enough to manage it themselves. You can set it up through our partner, BMO Investor Line. Visit bmo.com/online investing. Select Open an Account and indicate that you're completing the application on behalf of an individual investor to get started. With the BMO Investor Line platform, you get access to the investments you need to help your children's savings grow. Number 3, let them pick Canadian companies that they already know. Children love feeling connected to things that they're investing in. Help them understand that some of their favorite places to go, like the grocery store, are part of public companies they could be investing in. Number 4, set savings and investing challenges, and you can make this fun. Challenge your children to save and invest a portion of their birthday money or their allowance. You can match their contributions as an extra incentive. It's a hands-on way to teach them the value of money and patience. Now, number 5, make investing a monthly family habit. Pick one day a month to sit down and review their investments together. Talk about what's happening in the world, why prices changed, and how long-term thinking beats short-term panic. It's a life skill that will pay off for decades. You don't need thousands of dollars to get started, just the willingness to take the first step. Start small, stay consistent, and watch your children grow into confident investors. Noah Solomon, thank you so much for joining me on the podcast.
Thank you for having me.
Now, normally I just jump right into the markets and get your take, but I'd like to spend a beat on what outcome metric is, because you approach investing in a different way and you're using something that everybody is fascinated with, artificial intelligence, except you started, I think, a lot earlier than AI became the new fancy buzzword. So tell me a little bit about how outcome metric is structured.
So you're right. The way we invest is completely systematic. It's completely rules-based. Those rules are derived from data analysis, AI, and machine learning, which, to your point, has been around for a long time in various forms. They just didn't call it AI. Now, granted, today the computing power is much bigger than it was 20 or 30 years ago, and the availability of data is much bigger, so it can be better at what it does. But it's been around for a long time, just not under that name.
How is it different from like algorithmic trading?
Well, when someone says algorithmic trading, that the algorithm determines how you execute, not how you make the decision what stocks or bonds to buy or sell, but you've already made that decision. So when I think of algorithmic trading, it just says what's the most efficient way to trade it to lower your costs or get the best execution. Generally, when they use the algorithmic trading, That's what it means. Algorithmic investing is different.
And that's what you do.
That's where it actually tells you or helps you decide what securities to buy, how to weight them, etc.
Okay, so let's back into this story of how you developed an AI model to make your investment decisions and just go back in your investing career because you didn't start in computer sciences.
No, I didn't.
You started in investing.
Yes, I did. So I've been doing, I traded interest rate derivatives and currency derivatives at Citi and Lehman in New York from the mid to late 90s. And then I decided to go get my MBA at Wharton. And, a conventional MBA, including Wharton's, in the first year they force you to take an intro class in all the major fields from marketing to finance. One of those necessary or core courses they force you to take is a statistics course, which most people hate, by the way, but I liked. And I remember my professor at the time told me, you should have waived out of statistics because you know too much about statistics to be taking an introductory statistics class. So it's always been a fascination of mine, as strange as you may find that, or most people may find that. So I've always been involved in some kind of quantitative modeling. And then after Wharton, I joined Goldman Sachs in New York as a proprietary trader, meaning you have nothing to do with the outside world, clients, other departments you can't for obvious reasons. You're simply investing Goldman's capital. And what I was doing is investing Goldman's capital in a variety of quantitatively or algorithmically driven strategies, which is what we called them at the time.
And then 2008 happens. You were at Lehman?
No. I'd been at Goldman Sachs. I graduated business school at the end of 2001. So I joined Goldman Sachs at the beginning of 2002. And I was there until the spring of 2008. I actually left Goldman before the financial crisis.
To come here, to come home.
Correct.
And what did you do when you set up in Canada?
Well, the way it came about is I was introduced in New York to my current partner, David Cassie, by a mutual acquaintance. I didn't know David, had never met David, but David's history is he was, Wood Gundy originally, and then CIBC World Markets, where eventually he was CEO of CIBC World Markets. Upon succession in, I think, 2002, he left and started a boutique firm called Genuity Capital Markets, which was primarily M&A advisory, some capital markets activity, also had research and trading of Canadian stocks primarily. They did have an asset management business, a private equity fund, which was about a $400 million private equity venture called Genuity Capital Partners, but had never pulled the trigger on any kind of public security investment management. And, to use David's own words, because I've heard it many times, they had been approached by, teams of 2 or 3 people from different brand name firms here in Canada who either owned a small part or none of the firm they were working for and were looking to break away, start their own thing, maybe affiliate themselves with a Genuity for a brand, helping to raise capital, etc. But again, to paraphrase, his thoughts, he said, they all kind of did the same thing. They all went to the same school. And if you look at their returns, they were fine, but they were just fine. And we weren't interested at Genuity in doing anything that wasn't different and best in class. So they never pulled the trigger. When I met David in the spring of 2008 in New York, I described conceptually what he was doing. And he said, I don't know how to write code, but conceptually, I understand exactly what you're doing. And there were a number of reasons he was attracted to it and said, this is the thing. I think those things were, number one, it had sustained results over a long period of time, as opposed to, a lot of different nouveau strategies, which do well for a period and then don't do well, which he'd experienced at CIBC World Markets. He also liked the fact that although it was steeped in investment theory, it was algorithmic. Having sat on a number of investment committees over the years, he did not think that investment committees were good investment decision makers.
Interesting.
He said it was generally about they were too early, too late, too emotional, too what they read in the Wall Street Journal yesterday, too who has the loudest voice in the room. And in his opinion, they generally are not very good decision makers. The other thing he liked it was low volatility compared to similar strategies. Of course, if you're putting clients in this strategy, you want it to hold up well in the bad times, at least relative to your other choices.
Okay, so this is interesting because we're leading up to how you develop your own AI model, but you're first programming the AI model to have a certain kind of personality, which is, you're looking at dividend income, you're looking at long-term returns, so you're not looking to take advantage of short-term trends. Is that?
That's absolutely correct.
So it's not for the fast money type. It is for the buy and hold, looking to build and grow their assets for 10, 20, 30 years.
You're absolutely right. So this is as core gets. So dividend-paying Canadian stocks, or the official category name is Canadian equity income, is by far the largest category. Almost every Canadian investor has some part of their portfolio invested in dividend-paying Canadian stocks. So when we approach investors or potential clients, we're not asking them to do anything they don't already do. This is not a venture capital fund or a hedge fund or a private debt fund or something alternative. Our message is quite simple. We're not asking you to do anything you don't already do. You already do this. Let us just do it better using AI.
So the question is, everybody's looking. So with ChatGPT, I can't imagine that there aren't people out there who have put in which stocks are going to outperform. And ChatGPT is not yet good at telling us that. You've been building this model. Can you unearth in a quasi-simplistic way, what are the key factors? What are those long-term factors? You study statistics. That's all this is like understanding big amounts of data and how it correlates to other things.
So the main factors we're looking at is a company's history of paying dividends, whether they've grown it or cut it, how many times they've raised it, etc. And that's just a basic qualifier. So the first thing we do is we look at, a large cap universe of Canadian stocks, and we say, okay, which ones can make it past step one? We call it step one, which is, have you had a consistent history of, are you raising your dividends? Have you cut it at any point in the last several years, etc. So that's just deciding what stocks can conceivably be in the portfolio, which is a pretty simple process. There's nothing really magic about that. What makes it different is once you get that, pared down universe of stocks that pass the screen, how you weight them, how you put them together into some robust portfolio that can add value through higher returns or lower volatility, or in our case, both. And the way we came to it is a very funny way.
Tell me.
Well, as I said, dividend-paying Canadian stocks is by far the largest category in Canada. And relatedly, I would be the first person to tell you the world does not need another one of these. It already has enough, probably too many, and they tend to all look a whole lot like each other. And collectively, I'd say by and large, they all tend to look a lot like the index. So the idea of having a product in this category, this largest category, was not ours. The process was ours of how we go about it. But a few of our clients, we have some more alternative strategies. A few of our clients who tend to be quite sophisticated, ultra high net worth, family office clients, said, can you use your algorithms and your technology to build a better, quote unquote, mousetrap within this category?
So how do you do that? Is it the weighting?
It's the weighting. But our answer at the time was the only honest answer, which was, I don't know, because I didn't know. I'd never tried. But interestingly, before we were going to spend the time and the effort, because, to see if we could develop a model for this category, I wanted to do some due diligence on the competitive landscape within that category of dividend-paying Canadian stocks. And there's a couple things that really caught our attention.
Like?
And it's pretty dark.
Love it. Lay it on us.
It's pretty dark. It's kind of depressing and pretty dark. The first thing we did is we looked at the 10 largest dividend-focused Canadian equity funds in the country. And we looked at their top 10 holdings. And then we compared those top 10 holdings to the top 10 weights in the TSX Index. And they were almost identical. So what does that mean? It means they're saying they're active funds as opposed to index funds, and they're charging an active fee as opposed to a few basis points for a passive ETF or index fund, but really they're just hugging the index. I think the pejorative term is closet indexer. In other words, you'd be better off just, if you're basically mimicking the index and you charge an active fee, then your return is going to be the index return less your fee, which leads me to the second thing we found out, which is even more shocking, but logical given what I just told you. There's this report that S&P Global puts out for every major country, including Canada, semi-annually. And they call this report their semi-annual SPIVA scorecard. SPIVA is an acronym for S&P Index versus Active. And in that semi-annual scorecard, in the various investment categories, they will tell you the percentage of active managers who have managed to outperform their respective benchmarks over the last year, 3 years, 5 years. And as of the latest report, in that largest category of dividend-focused Canadian equity, 85% of managers have underperformed the TSX Dividend Aristocrats Index over the last 5 years. So that's when we kind of had this epiphany, this aha moment, in the sense that A, we were asked by clients, B, as I said, it's the largest category in Canada. There's certainly demand. It doesn't get more core than this for Canadians. And C, for whatever reason, it seems to be a category where the vast majority of managers have struggled to add value. So that's when we put our heads down to see if we could come up with something different and value added.
And so I feel like I kind of let the cat out of the bag. It sounds like the secret sauce, you alluded to it, is the weighting. How are you going to, it's not just that you're going to buy Royal Bank. It's how much are you going to invest in Royal Bank versus anything else.
You're absolutely right. And what I find, someone made this comment to me, which I'd never thought of, is almost or most managers can tell you why they own a certain stock, whether it be Royal Bank or a gold stock or anything really. But then if you ask them, why is this stock a 3% weight as opposed to a 2.5% or a 3.5%? Or why are you overweight by 1% or underweight? They can't tell you. We can tell you exactly why, down to the decimal plate, we have weighted a stock the way we have.
And what are those factors? Like, I cover the news, and the news seems to dictate, in some ways, the volatility of a stock, whether it's war or the prospect of war, whether it's interest rates, whether it's just the vibes, like how do you quantify that kind of like more ephemeral part of the market?
That's very interesting. So volatility, you have to think of volatility in general for stocks, and then the transitive property of how stocks are more or less volatile than other stocks. So a great example I could give you is, historically, Royal Bank is less volatile than tech, let's say. And let's say, I don't know if this is true, but let's just say over the last several years, Royal Bank has outperformed tech. What I can tell you going forward is that Royal Bank will continue to be less volatile than tech. That's usually a pretty good bet, given the nature of their industries, etc. But can I say that Royal Bank is going to outperform tech? So you can have, I'm not talking about volatility in the aggregate, because when there's a shock to the market, everything becomes more volatile. Generally, stocks do, or indexes do. But in terms of stocks' volatility relative to each other, that's fairly constant.
So you talked about all these dividend funds that are lagging the dividend index. And I imagine that you're only bringing it up, well, in part because you discovered this in trying to build a model that doesn't do that. But I guess the question is, Noah, is it working? Are you guys outperforming?
Yes. So we launched this fund just over 6.5 years ago in October of 2018. And we have outperformed that index that about 85% have underperformed, according to S&P Global, net of fees by almost 2,500 basis points. But that in and of itself need not necessarily be a selling point. In theory, if I had achieved this outperformance, but I was far more volatile, what makes it stand out is we've achieved those higher returns with considerably less volatility and shallower drawdowns in tough times. Because we're getting more of the good thing, return, with less of the bad thing, volatility, it means our risk-adjusted returns, or some people would use the term Sharpe ratio, have been more than 1.5 times the benchmark index.
And that's like well above what others are able to do.
Well, according to S&P, 85% have underperformed it. So
let's talk a little bit more about this model and how you put it into practice. And we're going to get into the mailbag and stocks, and you're going to give us your pro picks. But you mentioned something about drawdowns. You don't do as bad in drawdowns. Now, as somebody who has studied statistics of the market, and I'm sure you've gone back to every single crisis that we've had, how do you think about timing the market? And does your model remain fully invested at all times? Are there times where you move to cash? How do you think about predicting that next, whatever it is, 20% drawdown? Or are you not agnostic to it, but if you're in it for the long term, do you feel like that's not as productive?
We, in this vehicle, we don't. We're always 100% invested. I don't think about, what the next crisis could be. Here's the way we think about risk. There's really two ways to deal with whatever crisis may come a month from now or a year from now or 5 years from now. The first way is to say, we don't have a crisis today. Maybe there will be one in the future. And if and when one comes, I will figure out what I'm going to do then to manage risk. Okay. I don't think I have any ability to forecast when it's going to come. And when it does come, I don't think I have any ability to react better than the other person. I don't, generally speaking, the history of that is pretty sordid, and people who have tried to do it, very few have added value, most destroy value. So we take a different approach to risk management. I call this paranoia is built into the model. We just assume something's always bad going to happen. We don't know when. We don't know what, but really the effect of a bad thing is pretty much the same. I mean, whether it's the global financial crisis or whether it's, when Trump more recently had his Liberation Day and stocks swooned, or it was calendar year 2022, you just assume something's going to happen. So paranoia is built into the model. It assumes that something bad is going to happen, and rather say, well, I'll figure out what I'm going to do and hopefully I'll do the right thing when the time comes. It just assumes something's bad and it's pre-prepared for it, the way it weights stocks.
So that's interesting. It's funny doing this podcast, seeing what takes with our audience, right? You don't know. Obviously, the audience loves dividend paying stocks. So, hopefully this does very well from that perspective. But the other thing, the videos that do really well are the ones where, and we've only had a few guests say this, when they say, big crash is coming. And, somebody who's looking for views like me, that could be tempting to lean into. But to your point, that might not necessarily, it might be good for views, but it's not necessarily good for the portfolio, especially people who've lived through the financial crisis. There's ex-Lehman people out there who've now made a career out of calling for the next Lehman moment, and they've been calling for it since 2008. And that doesn't necessarily mean you're going to end up with higher returns going forward or even avoid the next big crash.
Well, you're right. There's a couple things I would add to that. I agree with you 100%. I think John Maynard Keynes said, the markets can stay irrational longer than you can stay solvent. The other thing he said is, taking too long to be right is indecipherable from being wrong.
It's my favorite.
Which is true. So it's very hard to time the market. The opportunity cost of always thinking the sky is falling. Macroeconomic predictions in general do not have a very good history of working out. There's this experiment someone did called the blind forecaster. So as I'm sure you're aware, at the end of every year in December, all the major strategists at the big Wall Street or Bay Street firms give their target price for the S&P 500 at the end of the next year. So they went back many decades and they took everyone's target price, and then they created a fictional character called the blind forecaster. And the blind forecaster doesn't know anything. They just assume the S&P is going to do its average return every year.
10%, 12%.
Yeah, something like that. So, if it was 1,000, they'd say it's going to be 1,010. The next year, they'd say it's going to be 1,020. And then you look every year at how far off everyone was and how big their average error to one. The blind forecaster beats everybody.
Beats everybody.
Beats everybody.
Just by going with the average.
Not just above average, it beats everybody. So I don't have a lot. So if it doesn't work, or at least in most cases it doesn't work, why do people do it? As you know, in the media, you hear all kinds of pundits. The market's going to go up. It's going to go down. We're going to have a recession. Inflation's going to be higher. Why do they do it? Now, I'm not saying people are dumb and that's why they fail. It's a very hard thing to do. When you think of what you need to do to get that right, you realize why it's almost impossible and why almost nobody gets it right consistently. So if nobody gets it right consistently, then why do they keep doing it? And why do we keep listening to it?
I guess it's entertaining.
Well, there's entertainment value. There's also safety in crowds in the sense that, everyone else is doing it. So if I don't do it, I'll look irresponsible.
I also think like those movies, those Big Short movies, they do kind of a disservice because yes, those people were right and they deserve their flowers for being right. But at the same time, if you were able to hold on through that period to now, if you just did nothing, you would have been fine. There's no movie really written about that.
No, I
person.
agree. The other thing I'd say, the other reason why people do it, even though it is the size of the prize. In other words, imagine if you could do it. What is the reward if you actually could predict short-term movements or peaks and troughs in the market to buy or sell? You would make Warren Buffett look like a chump. So the size of the prize is so large that people just can't resist it, but they ignore the historical data, which is a pretty big indictment of whether you should be doing this or not. The other thing is when people, all things being equal, most people would rather have less volatility than more volatility. And I get that. Nobody likes to see their portfolio swing around. And when they invest in lower volatility products, typically like a hedge fund or what have you, something with low volatility, I'm pretty sure they know what they're getting. That I'm pretty sure of, meaning it'll help reduce the volatility. Having this as part of my portfolio will help reduce my volatility and, provide some ballast in the bad times. But I'm also pretty sure they have no idea what they are giving up for that. In other words, and the human brain is not good at compounding, but let's take a theoretical hedge fund, and it's a good hedge fund. And what do I mean by a good hedge fund? It's a good market neutral hedge fund, meaning it gets 6% return a year with low volatility and low correlation to the broad stock market. That's a good hedge fund. Mm-hmm. And I'm giving the benefit of the doubt because ask how many have actually achieved this over the last 20 years. So I'm being very generous here. But even being generous, now let's say the market does 9. Now you take that 3% difference and you compound it over 20 years, you're going to have triple the pre-tax return. So like I said, because most people don't understand compounding, they're aware of what they're getting. They have no idea. Now, if you're retiring and you have to draw down
that's when
every
it
year,
matters.
that's when it matters. But if you are reducing volatility for a strictly emotional reason, not a financial reason, I suggest you ask yourself how expensive those emotions are.
We are going to apply this to certain stocks and sectors. Let's dip into the mailbag. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, so now Noah, we're going to apply all of that thinking to certain sectors and stocks. And our first question, of course, if we're talking about dividend paying stocks, what do Canadians love more than that? Or in addition to that, it's Canadian banks. So do you like the Canadian banks? Which one is your favorite? Do you own them all? Do you weight them all equally? How does it work?
So we do own them all because they all pass that screen, because I'm sure all your listeners or viewers know that they do pay dividends. I don't know if they've even cut them in my lifetime, let alone the last several years. And they raise them with cruel mechanistic frequency. I always said, if you believe in reincarnation, when I die, I want to come back as a Canadian bank. So they all pass the screen. They are all eligible, and we do own them all. However, any Canadian portfolio that I've ever seen, with very few exceptions, if you take the combined weight of the banks, it will be between 20 and 35% of the portfolio. And as I've rarely seen exceptions. This goes back to my, comment on due diligence and how they all look the same and they all look like the index. For the last couple years, the combined weight of the banks in our fund has been about 5%. That's
Low.
it.
Very low.
Very low.
Why?
Well, based on our conversation, you can probably guess it's not because I have a view on the banks. I don't know if I have a view on anything at my age anymore, but certainly that's not what we do, and it's not how we invest. All that low weight reflects is that, at least for the last couple of years, and I'm sure this may change at some point in the future, I don't know when, but the banks have been inefficient in terms of their ratio of the good thing to the bad thing. And what I mean by that is, at least for the last couple of years, if you want bank-like dividend yields, you can find those dividend yields in other stocks for less beta, for less volatility, for less headache. Or if I invert that, if you're comfortable with bank-like beta, I can find you other stocks with similar volatilities but have higher yields. So the banks haven't been offering a very good bang for the buck, bang being dividend yield and buck being beta. And what's interesting, and I never really looked at this, at least for the past several years, if you look at the total return on average for the banks, it's basically been very close to the dividend yield. There's been almost no capital gain.
Which means the stocks are not going up. All the return
Correct.
is coming through,
more or less,
through the dividend. That's super interesting. And then you're kind of saying Canadians we love our Canadian banks, but we're not being appropriate with how much of it we're stuffing into our portfolio.
Yeah, well, banks are kind of like a love-hate religion in Canada. So, we do pay high banking fees. I'm not going to get into that, but the point is, someone once made a joke, and it was, well, the only way to get back at them is to own the stock. So, but there is sort of, I know it, it'll never go bankrupt.
Yeah, stable.
It's stable, which is true. I mean, but presumably, your investing criteria should be a little better than, well, I'm pretty sure they're not going to go bankrupt. Like, it doesn't seem like too much to want a little more than they won't go to zero. So yeah, very low weight, which means it's a truly active fund. When I say active, I don't mean trading a lot, because it only rebalances the portfolio twice a year. The end of every June and every December. Between then, we're not making any changes to the portfolio. When I say active, I mean it's active share. It does not look like the index or your traditional Canadian equity exposure, which we think also means that, in addition to have performed quite well, it also adds diversification value, because it does not look like your traditional Canadian equity exposure. Back to the bank example.
And will that change? Like, right now it's 5%. Should it ever go up to 20, 30%?
If they start screening better on the criteria, if their dividend yield goes up relative to their volatility, and it's a little more complicated than that, but absolutely.
You mentioned the first step in your screening is the company steadily increasing their dividend? Have they cut the dividend? Which brings us to our second stock, which is BCE. Do you think BCE is a buy after its dividend cut? Will it make a comeback? This one coming from John in BC.
Well, again, given what we do, I'd say I don't think anything in quotes. However, because it did cut its dividend,
you were forced to think.
The model will not own it. It will not own it.
So you own a stock. Like, does it cut the stock out when the yield is 12%, like before the cut happens?
No, but it doesn't. The answer is no, it doesn't. And when Bell did cut its dividend, I don't know, a month or two ago, it won't get rid of the stock until the next rebalance.
So June it's out.
Which is coming up in a few days at the end of June. However, when I said we're weighting those stocks, you start off with a universe of about 140 of the largest Canadian companies. You then run that very pedestrian screen, which I described, and there's nothing particularly unique or proprietary or clever about that. But then so inevitably, let's say about 50 stocks survive that screen. You know, they've steadily raised their dividends, they haven't cut, and you're left with about 50. And now the question is, as I said, how do you weight them? For each of those 50 surviving stocks, we calculate the following ratio. In the numerator, we put the good thing, dividend yield. In the denominator, we put the bad thing, beta, and we weight it by that ratio. So for example, let's say only 2 stocks made it through that screen, for simplicity's sake. We'll call them Amber Co. and Noah Co. Amber Co. has a dividend yield of 4%, and so does Noah Co. So you and I have the same numerator. Mm-hmm. You have a beta of 1. So similar volatility as the TSX Index. I have a beta of 2. I'm a maniac. I'm twice as volatile. So you're a 4 over 1, which makes you a 4. I'm a 4 over 2, which makes me a 2. Yeah. So if you're a 4 and I'm a 2, you're going to have double my weight in the portfolio. If we were the only 2 stocks in the portfolio, you would be a 66.6% weight and I'd be a 33% weight. Now, we do limit the weight of any stock to 5%, but there's a little bit of a kink. Back to your Bell. The actual ratio we're using is a non-linear ratio of the good thing dividend yield to the bad thing beta. And I'll explain what that means, because when our algorithms were searching through the data for the last several decades and learning how markets price, reward, or punish characteristics like dividend yield and beta, we found those relationships to be highly nonlinear. And I'll give you 2 examples of what that means and you'll understand Bell. Take 5 stocks that have the same denominator, the same beta.
Same volatility.
Same volatility, yeah. Exactly. But their betas are their yields are respectively 3%, 3.5%, 4%, 4.5%, and 5%. As you go from the 3 to the 3.5, you should get a decent bump in weight for that extra 50 basis points in yield. As you go from 3.5 to 4, another bump, but a smaller bump. 4 to 4.5, an even smaller upweight. So the curve is concave, it decelerates. Eventually, once you get to around 6% or so, the curve is almost perfectly flat, meaning you get no extra weight for any extra yield at that point.
Because the market is not rewarding you.
What the algorithms would say, at least the way markets behave over the last few decades, is don't get too excited about some stock that's yielding 7 or 8 or whatever it is, some huge yield, and give it some huge prominent weight in the portfolio, because on a risk-adjusted basis, historically, this doesn't end well.
Let's bring this lens.
That would be Bell.
Let's bring this lens to a different stock, Manulife. A previous guest liked Manulife. This question coming from Georgia Milton. Does Noah like it, and would he buy it here? And I want to talk about Manulife because for a long time, there was a lid on the stock and then it broke out. And I'm curious what your model does with stuff like that. Does it care about stuff like that?
It doesn't care technically that it broke out of its range. I don't think about Manulife, but we do own it. The algorithm.
Like, are technicals factored into your statistical model? Not at all.
No.
Okay, good to know.
There's no momentum. But we do own it. It is a reasonable weight in the portfolio, not the largest weight, but it is a reasonable weight. We do own it because it passed the criteria, and its current weight, its current characteristics in terms of its ratio of the good thing, dividend yield, to the bad thing, beta, is quite attractive, and therefore it has a reasonable weighting in the portfolio.
Just as a teachable moment for volatility, sometimes, like, what if it's volatility to the upside?
That's very interesting. So generally speaking, at least over longer periods of time, and I've tested this, generally speaking, it's very rare when a stock has a lot of volatility to the upside, but not a lot to the downside eventually. Like I've tested this. So it doesn't matter. It doesn't factor into our portfolio.
A smaller stock, and I'm curious how this factors in, Cargojet, which has struggled. I'm thinking of buying shares of Cargojet. Is it a buy here? This one coming from Arnie in Toronto.
The model does own Cargojet right now. Our portfolio does include Cargojet. Again, it's not the heaviest weight, but it's not the smallest either. It's a reasonable position in the portfolio. Again, because it screens positively in terms of steadily raising its dividend and not having cut it. And again, its yield relative to its volatility is quite attractive. So I wouldn't say I like it, but the model likes it. And I defer to the model, which has proven its mettle over the last 6.5 years.
So the market has not liked it. The investors have not liked it because the stock is down. And I guess that would be obvious because it gets caught up in trade, right? And tariffs. And so I'm curious about how, again, I know it's all statistics and all numbers, but when trade and tariffs are kind of dictating everything or picking on names that are vulnerable in that environment, and they pay a dividend, Cargojet does pay a dividend, but people aren't looking at Cargojet for the dividend. They're looking at it as a play on global growth or global trade, whatever. It's not the factor that drives Cargojet, but it's in your dividend fund. How do you think about all of that?
So we don't. We don't. I'll say a couple of interesting things.
But shouldn't you, I guess is my question.
Well, I'll put it, Cargojet is one stock, and we're never going to be right on every single stock. Imagine if I was right on every single stock, or the model was. Then again, I'd make Warren Buffett look like a chump. You literally make no mistakes. A model, really anybody, whether you're doing it algorithmically or not, you're trying to be right on average. You're trying to be right more than you're wrong, or at least when you're right, you're trying to be more right than the magnitude of your wrongness when you're wrong. What I will tell you interesting, and we do get asked this all the time, is, well, what do you do when, Liberation Day happened? So the last time we rebalanced this portfolio was December 31st. I guarantee you I had no idea Liberation Day was going to happen. And then Liberation Day did happen, and markets went down quite a bit, quite fast. And what did I do? Nothing. Now, what's interesting about that is
it worked.
Well, we're up 14% on the year, but during that, I don't think that fund was ever negative year to date at any point. Again, and I didn't know it was going to happen, and I didn't do anything when it did happen.
Because
paranoia is built into the model. I just assume something bad is going to happen. And relatedly, AI, we hear about AI and whether it's applied to investing or medical science or social media, we often hear the reasons why AI is superior to HI, human intelligence, because of what it has or what it can do that humans cannot, which are obvious. The ability to induct huge amounts of information, very quickly do tons of calculations almost instantaneously and render a decision. Granted, that's true. That is an advantage, but we also don't hear about the other advantage of AI, which isn't about what it has that humans don't. It's about what humans have that AI doesn't.
Which is?
Emotions.
That's true. And I think we're going to get a clue into why the fund did so well during that period in your pro pick. So let's get into it. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so we didn't touch on this throughout the whole show because I knew we would get to it in Pro Picks. It's your view on gold and precious metals. And am I right in saying that one of the reasons your fund did so well post-Liberation Day was because you had such a big weighting in gold, and gold did extremely well?
Yes, you're absolutely right.
And I can't think of an asset that draws out more emotional investing than gold. So you've built this AI model to cut out human emotion, and you're overweighting gold. Tell me why. Or what's screening so favorably? I know you can't tell me why, but what is so good about gold right now?
Well, to your point, gold is a very emotional, we have people that are gold bugs, I think is the term. Presumably most people or managers would buy gold stocks because they have a bullish view on gold. I do not have I might have a view on gold, but it certainly doesn't make its way into the way we
they're scared of something.
Stocks. Or they're scared of something.
Yeah. The AI model isn't scared of anything.
It isn't, but it doesn't own gold stocks because it has a bullish view on gold, unlike why most managers would own gold stocks. What it understands is that gold stocks are the only group of stocks as a group, never mind a single stock, but as a group or a subsector that has no correlation to the index. None. They don't. Even staples may be defensive, but they are correlated. If the market goes up 1%, they'll go up less. If the market goes down, they'll go down less. But they are correlated. They still go up and down with the market. Gold stocks are the only group of stocks that have no correlation. So back to that weighting ratio. What the model understands is that starting a couple years ago, there's several of these companies now that are screening. They've been positively raising their dividends consistently. They haven't cut them. But then when it comes to the weighting ratio, it understands mathematically their diversification value. That denominator is low because, as I said, they are the only group of stocks that have no correlation to the index. In other words, it's weighting them prominently, not because it has a bullish view on gold, but because it understands their diversification value mathematically.
And how that's manifested today in ProPix is through wheat and precious metals. And so I'm curious about the weighting there, and if that's, that's more of a streamer. So if you've overweighted like the streamers versus the actual miners, or are you owning a basket of gold stocks? And you just told me about wheat and precious. How does that work?
Well, we own both. So we own Wheaton and we own Franco-Nevada. We own a little Kinross. So that's the stocks it owns, only because...
And are they up to 5%? You said each stock is capped out at 5%.
Two of them are at about 5%. Again, we haven't rebalanced yet. We will in about a week at the end of June. But it's looking like their betas have been picking up.
The volatility.
Which isn't surprising because I think when something becomes in vogue or in focus by the general investing public or by, fast money hedge funds, then they become what I call a hedge fund toy. You see the volatility start to pick up. So I wouldn't be surprised if in the next rebalance it took that weight down.
But still bullish. It's not.
It's still going to own them, but I would think they would have lower weights.
Okay, good perspective for our audience to look at those gold stocks, but maybe pull back a little bit on exposure. The second one is Empire, which is the grocery store. It's a consumer staple, owns Sobeys, Farm Boy, etc. Recently hit an all-time high.
Yeah, so we are overweight the staples, namely the groceries, the Loblaws, the Empires, the Metros. Again, when you think about them, they're very low volatility, not just mathematically. I mean, when you this is not what we do, but the reason they're low volatility is, back to Liberation Day. Number one is they don't have a big cyclical beta, what I call. In other words, they're not particularly sensitive to recession. I mean, people need to eat. And chances are, if you need to eat, you're going to one of those three and maybe Walmart because we have a very entrenched oligopoly. The other thing is they're not really affected by tariffs. They don't sell abroad. Mm-hmm. And to the extent they have to import things, they can easily pass those costs through to consumers.
So you are capturing those soft factors
in the denominator. It's captured in the beta, yes.
Yeah, in the volatility.
Absolutely.
Because investors are pricing it in, and the model looks at how are investors pricing that in.
Exactly.
Okay, I'm starting to understand the model a little bit better. So then something like valuations or momentum, where does that show up in all of this?
It doesn't.
It doesn't.
And, a lot of people are, quote unquote, bothered by that. You mean you don't look at valuation or you don't look at So here's what I'd tell you. I think Charlie Munger said, always invert. Warren Buffett's partner said, always invert. So let's assume, here's what we know. We assume that S&P is correct in the sense when they say 85% underperform, let's just assume they're right, that they have good data and they've done their work properly. Fine. Now, this is a little bit of a leap of faith, but not much. Let's say of the several hundred managers in their database, let's assume, and I think it's a pretty good bet, that the vast majority of those managers are picking stocks and constructing portfolios by way of classic fundamental bottom-up, value investing, maybe a little macro overlay in terms of their view of the interest rates or inflation or growth. Fine. So we know that most of the vast majority underperform, and it's a pretty good bet that most of them are using the same tools, the same approach. Okay, so why would I want to do the same thing as everyone else that is leading to almost 90% of them underperforming?
So you're saying valuation doesn't matter?
It does matter. I like to say that Adam Smith always wins.
And for Adam Smith non-stans?
Like that Adam Smith who's been dead for 300 years.
Yeah.
In the sense that if it's a battle between, 100 of the best income statement balance sheet analysts on one side and Adam Smith on the other, he'll win every time because he knows, simple supply and demand, that they will arbitrage each other's competitive advantage away. The problem isn't that they're all trying to outperform. Seems like a worthwhile endeavor. That's not the problem per se. The problem is that they're all trying to outperform by using the same tools. And therefore, none of them can outperform.
So you've put that tool to rest.
So why would I want to do the very same thing that is leading the vast majority of managers to underperform? So back to your question, you don't look at valuations? Well, they are, but it's already in the price because they're all doing the same thing.
That's a good point. I never thought of it that way.
Adam Smith always wins.
That's a bumper sticker. I imagine if there was going to be a bumper sticker on your car, that could be one of them.
I hope I can keep winning when I've been dead for 300 years.
Yeah, that's timeless investing. Hopefully ProPick stands that test of time. Your last one here is Capital Power. That one's interesting because that chart is like a little choppier. What is screening as attractive there?
Namely, the same things as everyone else. They've been steadily increasing their dividend. They haven't cut it, and their yield relative to their volatility, although to your point, the volatility has increased. So it'll be interesting to see. I haven't looked at our rebalance that's coming up in about a week, whether it picks up that extra volatility and they get down-weighted.
Do you ever override the model? Do you ever look at it and say, well, what are you thinking?
No, I don't. And the reason being is presumably, well, not presumably, you've put all this effort, tremendous effort into building and refining these models, which you've found to have some value, to be able to add value, to do better than most. Then what would be the point if you've spent all this effort then just to ad hoc spontaneously override it? You might as well have not done it in the first place.
I guess, yeah, you have to rein in your worst instincts.
Yes, you do. You do.
Noah, it's been an absolute pleasure. Thank you so much for joining me on the show.
Thanks for having me.
That was Noah Solomon joining us. Make sure you tune in to our next episode. We've got Joanne Feeney on the show. Now, she talks pretty much all U.S. large cap. So if you've got a question, you can email us at questions@inthemoneypod.com, or you can find us anywhere at social media @InTheMoneyPod, and we'll see you on the next episode.